All right, welcome everyone to another episode of the podcast. Joe here and with Luke. How are you, mate?
Yeah, good. How are you?
Yeah, going well. Today we thought we'd just give everyone an update on tax matters that are sort of changing or coming up rather than giving a specific topic. Should we rip into it? Where do you want to start? Payday Super?
So what's coming up with Payday Super? Has anyone heard of it? Do you know what it is?
I know what it is, yeah.
Yeah, I do as well.
Thankfully.
Yeah.
Do you want me to run through it?
Yeah.
All right, so effectively when you run payroll now, well, from 1 July 2026, you have to pay the super at the same time. So it's not just pay the wages, it's pay the super as well.
What happens currently?
Currently, you have till the 28th of the following quarter to make the payment for that quarter.
Yep.
But now you got to pay it pretty much straight away.
Yeah, so basically clients should already be doing that. Whenever we see clients, they've got problems with cash flow. The reason for that is because they wait 3 months and then there's a big lumpy payment. And the best way to fix it is to pay it straight away anyway. So if you're a client of ours, you're probably already doing it. If you're not, we're probably telling you to do it.
Yeah, best practice is to do it anyway. We encourage everyone to do that. But from 1 July 2026, you have to do it.
Yeah.
The important thing there is you need to have a software that allows you to do it easily. The ATO clearinghouse not going to be effective. You need to use a Xero or a MYOB or something or a bigger system that can process the super with a couple of clicks of a button.
Yep. And so as a director, you should be doing this anyway, because if you're a director and you have unpaid super, if you go to liquidate the company, which is one of your protections, I guess, against business liabilities, super you have to pay anyways. So what's the point in not paying the super just to go into liquidation and then have to pay it anyways? If it was me, I'd not pay the wages and pay the super, because the wages, you don't have the same sort of DPNs that are served against you. So I would honestly super is probably the first thing I'd pay.
Oh, absolutely. Yeah. You don't want to be not paying super and then paying a different supplier.
No, 100%. Yeah.
It's one of the things you can get in trouble for as a director.
Yeah, no, it's silly because a lot of people will pay wages and not super, but as a director, they can't chase you for wages. Obviously, they actually can't, you know what I mean?
The employee will.
The employee will try, but they'll chase the business and not you. Whereas, you can get personally done as a director for super. So, yeah, I would pay super for wages. I pay super for everything else. But for some reason, some morons just don't do it.
Yeah, so if you're not set up, ready to go for that, 1 July 26, let us know. We can help you out.
But, yeah, so property development, when you set up a property development company, for all the property developers that are listening, you basically will set up, a construction company or a development management company, and you'll have SPVs through there. What the ATO is cracking down on is how the contracts between the intercompany entities all work. So they want to see proper agreements, which lawyers do, and all that sort of stuff, and they just want to make sure it's all above board.
Do they want to check that it's a market rate that you're on charging, or they're not caring about that?
No, they'll check market rate, but they'll also check on dates of invoices and progress payments and all that sort of stuff. So, they're just having a closer look at that sort of stuff.
Secondary to that is another property related one where the ATO is going to start cracking down on deductions relating to holiday houses. So if you...
This one's juicy. Yeah.
This one is juicy because there's going to be a lot of people getting scared for this, and they should. Yeah. But essentially, if you have a property that's what the ATO then views as a holiday house where, for example, you use it personally in all the peak seasons and then you rent it out for the rest of the year, they will consider that to be a holiday house.
Yeah, so what a lot of clever people were doing, and I just love when clever people do stuff like this, is they were going and getting in a beautiful beachfront Airbnb. They'll have a loan against it, and then they will go and use it on, the weekend, Boxing Day till, New Year's Day. The only week that it'll probably get booked out, they'll use it personally, and then they will rent it out on all the, school, not school holidays, non-school holiday periods where no one's going to book it. And then they would claim all the interest deductions and be
they could apportion the interest based on time.
So, yeah, so you got 1 week out of 52 weeks, so you're going to apportion almost the whole interest thing. And then you have no income, so you just got this big negative gearing thing, and you got this asset that's going up because it's beautiful Airbnb holiday house, right?
Well, you got the income of the Airbnb.
Yeah, but you've just taken all of it because you're the only person booking it for the week. You know what I mean? So they're just rorting the system a bit. It's a clever rort. I got to tilt my hat to them. I love seeing that sort of stuff. But yeah, what Joe's saying is the ATO is cracking down on it. So go again, like, yeah.
Well, essentially, if your house is considered to be a holiday home, you won't be able to claim any of the ownership costs as a deduction at all. You can't apportion it at all. Yeah. So the income that you get from Airbnb is still accessible, but interest apportionment will go. So you have zero interest. Council rates will go.
Depreciation.
Anything like that will go. All you can claim is the running costs against the Airbnb. For example,
electricity,
cleaning,
water.
Like cleaning costs and all that kind of stuff.
Electricity, water, yeah.
We have to check with that, yeah.
That'd be running costs. Yeah, okay.
Specifically related to the Airbnb income or whatever you're renting it out through.
Wow, when's that come into effect?
They're looking at it to start from 1 July.
That's a bit of a shame, isn't it?
It's not official yet.
It's good for housing. Cause
it's not official yet. It's draft, but if that comes in and you have a holiday house, I'd be looking at it.
Yeah. Well, yeah, so either use it as 100% Airbnb and you can't privately use it so you can claim everything, or, turn it into a short-term rental or something like that.
Or turn it into long-term rental,
Yeah. Or it's your holiday house and you should probably use it more than a week a year.
Yeah, but then you won't still be able to claim any that it costs, so...
No, correct. It's a proper holiday house. It's not an Airbnb then. I wouldn't even rent it out for Airbnb.
No, correct.
Yeah, yep. So... Div 296, it's talking about the 3 mil cap with super. So anything that's above 3 mil is going to get taxed at 30%. Yeah.
Now, that's been around for a while, but they did change.
They changed it. So, the new thing that's come out now is they're not going to tax the unrealized capital gains. Thank God, because that would have taken us into, a really weird scenario where, do they then come after external to super and everyone was freaking out. I was freaking out a little bit, but I always knew this was going to come. It was never going to happen. Yeah. So Div 296. So basically, if you got 3 million super, depending on your structures and stuff like that, could be cheaper just to leave it outside of super and in a company because you're getting 30% tax. Obviously, companies got different structures and stuff, but it depends on your goals. You still got to get the money out of the company to use it. But if you're trying to preserve wealth and
Yeah, so especially when you're looking at retirement, when you're at that 55 plus age, it is something to speak to your accountant about. And if you've got an SMSF and you're not having those conversations, then Andrew from our business can help you out. The other one that I just want to touch on is some people aren't aware that when you sell your main residence and you're over 55, you might be eligible to contribute up to $300,000 into your super fund. Per person. So if there's a couple and it's both your main residence, then you could do 300,000 each. That just helps with your retirement. So if you're sort of over 55 looking to downsize, make sure you look at that one.
Yeah. Because I guess from a tax perspective, obviously super has the lowest tax rate. So if you're putting money into super, you could have a zero tax rate depending on your age and what you're doing, which is why you'd probably want to get money into there, you know what I mean? But speak to your financial advisor as well about whether it's a good idea for you. Yeah.
You still can't touch it until you meet the eligibility requirements of either 60 or 65.
Yep.
So, but even if you put it in at 55, but at least once you turn into pension, you might not be taxed on the income, all the rest of it. So
yeah, it's definitely personal circumstances on all this sort of stuff. Call us, we'll be able to give you the tax advice on it. There's also Div 293, just to remind everyone. So if you earn a lot of money and you think you pay a lot of tax, you don't pay enough. You know what I mean? You got to pay a bit more in super. I love it. Man, everyone gets those letters. So obviously we get a lot of high income earners that come through our doors and they always get this letter. And it's a Div 293 notice, which basically everyone pays 15% on their super contributions. So your employer will pay money into the fund and then you'll get taxed 15%. If you earn over 250, I think it might be high now, it might have been indexed to 270 or something. But basically if you earn over sort of 250, combined, so package like super and outside of super, then you get slugged another 15% on that. So you're paying 30% in super on your employee contributions. Man.
It's a rip.
Oh, man, everyone hates it. Oh, it's a joke. Yeah, no, it's a joke. I remember I almost never saw one of these things, probably for the first 15 years being accountant. And now everyone, not everyone, but a lot of people earn more than that now. If you live in Sydney, you almost got to, you know what I mean? So, our bin's full of all the letters. That's how many are coming through. And the politicians, hopefully they're spending it wisely. That's all I can say.
Yeah, correct. I might just touch on one about electric cars. So a lot of people have bought electric cars recently, and now it makes up about 8% of the cars in Australia. The government previously gave a lot of tax incentives to do so. They're reviewing that at the moment, whether they remove those incentives, because obviously a lot of people are buying them anyway.
They were generous.
They were generous.
You didn't have to pay. So like if you bought an electric vehicle in your company, there was no FBT.
On the private, yeah.
Yeah, so like you could literally, I don't know, like you could use it in zero for business and just buy it in your business and you would get...
No fringe benefits.
It was amazing.
Yeah.
So you get a full deduction in the business, like, which is absolutely amazing.
Yeah, the luxury car tax limit is higher than an ordinary car and other tax matters, like tax-related things, like import
How much
costs.
higher was the luxury car tax limit?
Oh, significantly higher.
Wow. Okay.
91,000 compared to
62.
76 this year for normal cars.
Yeah, wow. Okay. That's crazy.
The import cost is also lower, which is another tax saving essentially because your cost is going to be lower to buy it. All these things are being reviewed. So they don't think they're going to backdate it though. So, the quicker if you're going to buy an electric car, I'd probably buy it sooner rather than later if you're going to buy one.
Yeah. It would be a bit rough if they did backdate it. Yeah. No, but like they're going to have to give like a month's notice as well because like it's like as soon as you order it, you have to use it before you're allowed to do the depreciation. You know what I mean? Like,
yeah. So, they are looking at it. So the sooner you look at that, public consultation it says is not due until mid 2027. So you got a bit of time, but I wouldn't be waiting 2 years to buy an electric vehicle if you're going to buy one. If you want the tax incentives, I'd buy one because it's good for the environment, but it might not cost you. It might cost you more.
No, all these rules, think about it, man. Labor's going to actually
We're not talking about politics on here, mate. We have differing views on that, so let's leave that out.
We'll wait and see. You heard it here first.
I sure hope not. Do you want to touch on income splitting?
No, I will get to that. But first, I thought I'd just talk about the ATO stance. So, like, we've been doing accounting for a long time, and like they got pretty rough lately. Like, you know what I mean? Just in terms of like lodgement dates, calling, following up bills, like payment plans, reversal of interest. So, like, back when Joe and I started accounting, like a long time ago, it was probably like I started GFC. You would have started around the same time. Yeah, and like it was pretty relaxed. Like obviously, like there was like the economy wasn't doing well, and like basically like I remember at uni, I studied profits for the whole thing, and when I first started accounting, I didn't see a profit for 2 years. Like I did losses for every single business, and I didn't know how to account for losses. There was no tax. It was a bit crazy. I didn't have to do DTAs and all that sort of stuff, luckily. Like, just left it for tax. But it was a bit crazy. But obviously, in a period like that, the ATO sort of like acts as your partner and helps you on your cash flow and all that sort of stuff. So
they were your friend then,
yeah. So it was fine.
Up until COVID.
Yeah. Like, correct. And then they were sort of friendly, but then like the economy started going well in like 2016 or whatever. Like, you know, and they started being like still friendly, but not as friendly, like, you know, for the years before. And they got a bit rough, and then COVID hit, and then they became like probably the most friendly I've ever seen. Like, there's tax debts they didn't follow up for like 3 years. There was big tax frauds happening. Like, so they were like very, very, you know, nice. And now, like the regime, I've never seen anything like this. This is crazy. They're tightening like crazy.
It's probably how it should be. Like, realistically, a lot of people
like
are taking the mickey, can't get away with much now.
You can't get away with anything.
Yeah.
I've seen, so like I've had, basically that for our whole careers, you used to call up the ATO and ask for a reversal of interest, and if you paid the whole amount, they would just reverse it, and they were lovely, you know what I mean? But I've had a guy like one of our clients recently, and he had like literally some of the most harsh stuff, family members like passing away in hospital, taking care of him, all that sort of stuff for like 12 months, asked for a reversal of interest, and they said, oh, got nothing to do with why you didn't pay us. It was brutal. Like, you know what I mean? Like, I thought it was a shoo-in, like when I saw the application to reverse the interest, but even that, they're like, no. And normal stuff, obviously, they've said no to all that stuff. And then I read articles like that, they're like, oh, they're remitting 86% of whatever. I'm like, oh, I haven't got one, mate. I haven't got one.
Yeah, there are specialist lawyers that now look at this, like that is their whole job. Yeah. I actually know someone. I haven't told you this yet.
No, send it to me, man. Yeah. I've got a couple of entities I want to see, yeah.
Yeah, and they literally know the tax law better than the ATO, so much so that they get everything reversed, payment plans approved, all the rest of it, and they just charge based on success.
Send them over. Yeah. No, send me one. Honestly, like, I've got an entity or two that I want to put through, which is good. Okay, yeah. No, so it's crazy anyway. So, yeah, if you're out there, obviously we've spoken before, interest isn't deductible anymore, which is even worse. So if you've got the cash flow, pay it. If you don't, call us up. We'll go through some solutions with you.
Don't put your head in the sand is the main thing.
Oh, that's the worst.
Don't start not lodging things on time and putting your head in the sand, because that's when you really get yourself in strife. Right? If you're lodging everything on time and there's cash flow issues and you haven't just sucked all the money out of a company yourself, then there's things that can be done. So just speak to us. We'll refer you to the right people. We'll help you as well, and just get it resolved. Yeah. Yeah.
So. Also, so like onto the income splitting now. So there was a funny article in the Australian Financial Review early January that came out, and basically in the article they were talking about business owners that split their income with their spouses. So there's like this thing called like the Everett assignment. And it's about like business income versus personal services income and like what you're allowed to split. So if you're a business owner and you're a professional services, like I'll just use an example, lawyers, because the Everett assignment was a really smart lawyer who gave a portion of his profit to his wife, and like he took the ATO to court, and then that was the Everett assignment was. Yeah. Oh, man, he's clever, because he like actually assigned the profit over to her. Like it's basically the same as the shares. And then the ATO's argument was like, well, you charge X amount per hour for that profit, so it's really personal services income sort of thing. Anyways, like then they had to decipher what was personal services income. So what's part of his salary that wouldn't be done, and then they assigned business profit. So basically, I had like a lot of clients call me that actually run a business, and I sort of told them, you don't have to worry about it. You've got a genuine business. If you left the business, you would still have the profit. And it's the same as like investing in the stock market. When you get paid a dividend, that's like pure profit, you know what I mean? But then we do also have like some lawyers that called up, and then basically if you're a good law firm, like you've already got an Everett assignment sort of thing, and you tell everyone what they're allowed to split between the spouses. And it's always like way, way, way lower than what the Everett assignment's allowed, you know what I mean? Yeah.
And I think like there's generally like if you see an individual lawyer high earning and he's got a group, he or she has a group set up, you know, if the average tax is 30% across the whole group and individually, then you're not really going to get, there's no real red flags. No. That's always been sort of the view of the ATO. Yeah. It's if you're essentially splitting out your income and you're paying less than that, then the red flags are going off.
Yeah. So it's basically,
and the paperwork needs to be there.
Yeah. But yeah, if you've set up a business and you can step back and the business pays, like then it's sort of like investing in the stock market. So the Everett assignment doesn't matter. If you're still involved in the business, you're not getting paid a salary, and then you're allocating it across everywhere else, then there's probably some issues.
I mean, essentially for a lawyer, they work X amount of hours a day. They charge out at X rate per hour. Yeah. That for them, their individual one is going to be their income, but they also have staff that charge out at rates and they earn profit from that. So essentially that's what they're trying to split out. Correct.
And that's what it's all about. So that was what the article was talking about. They were saying like the ATO is cracking down on that sort of stuff, on top of all the other tightening they're doing. You know what I mean? So
yeah, there's a lot of cracking down in this one. Sorry, guys.
Yeah. No, they sort of have to, but like, I mean, I always like think, just as a theoretical question, is like they always raise interest rates when the economy's too, hot. Like, why don't they just raise taxes? When you raise interest rates, you're only really punishing people, 25 to 55 who've got a mortgage. So, like, why wouldn't you just raise taxes? You can build more stuff, like, or pay for better things, and you're taking the heat out of the economy. So, like, why raise rates? Obviously, there's, like, foreign exchange and all that sort of stuff that I'm probably not thinking of. But just as a society, like, I reckon they're probably, like, to Labor's credit, they're probably tightening because it's helping them not raise rates. Like, in a lot of circumstances. Like, our inflation figure is too high. They're going to tighten taxes without sort of telling us, or tighten, like, cash flow and stuff like that. And then that's going to help bring the heat out of the market without having to raise rates and burn all those people.
Correct.
Yeah.
Yeah, if everyone paid, they wouldn't have to increase tax rates. Yeah. That's what they're trying to do.
Yeah. And if everyone paid, no one would have money to do anything and there'd be no inflation. No, literally, like, yeah. Because, like, oh, mate, some of the people that we see, literally, they just, like, pull money out, don't do any of the taxes the right way, and then they're out spending it on, you know, whatever the hell they want, stupid stuff that they can't afford, and then they come back and they're bankrupt. Like, yeah.
I just thought I'd touch on AI quickly, which is a hot topic at the moment. I've probably mentioned this before, but one week I had 3 people call up and say, AI's told me this is the answer.
Oh, mate. Yeah.
ChatGPT told me this.
I get that all the time.
Yeah, it's a shocker.
Oh.
It's really important that people don't rely on like ChatGPT to answer their tax things. It can be a tool that you can sort of help explain a thing that you don't understand, like what is concessional or non-concessional super, for example. If you don't quite understand that, pump that into ChatGPT, probably give you the answer. But if you're putting, firstly, like if you're putting private data into there, crazy, because it's going into the ether. Secondly, like you can't rely on, there's cases in the courts that the person's relied on answers from AI and it was wrong. Like cases that didn't exist or cases that weren't relevant to their situation. Didn't exist.
Wow.
Didn't exist. Right?
Yeah.
And they've used that along with cases that did exist but weren't actually relevant to their case. Because that's what ChatGPT popped out.
Yeah.
They've gone with that down that path and obviously got audited, all incorrect, hit with significant penalties and all the rest of it. And it's a very easy case for the ATO to win. It's like, well, it's actually not the rules.
Yeah, no, so my experience with AI, like I did try it a bit at the start and then obviously use it a little bit here and there, but like I asked it like really specific hard questions. So like I knew that there was like tax law and like you can look it up on Google, right? Like the sort of questions I asked it was like you go look at Google and there's a couple of like, you know, articles on it that are wrong. Like, you know what I mean? So I was like, all right, I'm going to try this. So like basically I'd ask it like really, really complex, like specific tax questions and see if it was right. And like I asked it like 11 specific ones and like not one of those were right. But like I do put the caveat in, like I asked it when it was like really, really difficult. Like ones that I knew that were like so particular that you have to go and like find the case and all that sort of stuff. But yeah, 0 from 11. So man, it's pathetic. Like, like add advice. Yeah.
Yeah, so it's a good tool to just like explain something better in tax or accounting or whatever. Yeah. But if you can't rely on it.
No.
And like so, if you are then relying on it for your situation, like can I claim this deduction, all the rest of it, you can get yourself in strife.
Yeah. It is getting better, but like it's definitely not usable to that extent yet.
No, certainly not.
Yeah, it's sort of like when the internet came out. And there was like the .com bubble and everyone was like, oh, you're going to be able to do this like on the internet, right? And like 25 years later, we can do that. But that's what everyone was saying about that bubble at the time. So now AI, everyone's like, oh, it's going to be able to do this. But in 25 years, it probably will be able to do that. But right now, it's like pets.com. Like no one's coming with your thing. Like, I mean, they're not getting a delivery right now. In 25 years, they're going to give you good advice. But for now, it's just crap.
Yeah. I had a client that said, oh, I'm going to set up the trust and all that kind of stuff to change a shareholder. I was like, no problem, go for it. And then he's asking me, did he do it right? Because he followed ChatGPT kind of stuff. And I'm like, mate, if you want to pay me to check it, I will. Yeah. Or go ask a lawyer. But essentially, like, that's on you if it's wrong.
Yeah.
Like, don't put it on me now.
Yeah.
You know, so it's like that kind of thing.
It was definitely wrong as well. I can guarantee it. I didn't even have to read it. Like, but I can guarantee it's not right.
So anyway, ask if you're not sure. Don't rely on ChatGPT. Use it where it's relevant. Yeah. Perfect. Anything else you got on your list, mate?
No, that's it. That's your accounting in the news update for January 2026 and February first week of 2026.
Perfect, mate. And yeah, if anyone has any questions, hit us up.
Yeah, definitely. And if you got any news articles you want us to explain, because they do get a little bit dicey in there. Like even when I read them, sometimes I'm like, what do they even mean by that? And I've got to go search it myself.
Yeah. Any new clients, how can they hit us? sales@obsidianadvisory.com.au.
Yeah, come through. sales@obsidianadvisory.com.au, or you can reach out to me or Joe.
Yeah, call the office number.
Yeah, 100%.
Perfect, mate. Enjoy your day.
You too.
See
Thank
you,
you.